Okay, so I'm here with my good friend Christine Farnish, who is the chair of the P2P FA. We're going to have a bit of a discussion here about what's been going on with the P2P FA and with the broader industry. So why don't we get started by, Christine, just introducing yourself and sharing a little bit about what the P2P FA does.
Sure, and first of all, Peter, a big thanks to you and the LendIt team for putting this event on, and it's fantastic to be able to partner with you again. This really is the flagship event, I think, on peer-to-peer lending of the year, and obviously the UK is a key market, so it's great to be able to have this opportunity. P2P FA has been around now for 5 years and really exists to do three things. One is to make sure that standards of good practice exist in this new sector of the financial services market. A second one is to try and promote better understanding of what peer-to-peer lending is and what it isn't, because there is quite a bit of confusion still out there. And thirdly, and really importantly, it's to try and make sure we have the right sort of regulation for this really exciting new industry.
Mm-hmm. Okay, well, let's just talk about that for a little bit, because we just had Chris Woolard up here, and he talked pretty emphatically about the importance of consumer protection and the fact that now they're going in and reviewing what's been in place. So, what would you say? I know that you helped develop the regulations along with many of your members, and so how do you think it's been going? What do you think the FCA in your conversations would say about how things have been going the last couple of years?
Well, it is very early days, and I mean they're only really now gearing up, I think, to do the regulation that they've put in place properly. And with the authorisation process that Chris described, that's been going on seriously now for quite a few months, I think that's the first time the FCA have really woken up to how peer-to-peer lending works and what the business models are and how it fits with the rest of financial services. So it's gone from a bit of a sort of theoretical exercise for them to a real live exercise. And I think it's good and healthy that they are now looking again at the regime they put in place, and they thought about it in 2013. So it is a little bit of time. I know it doesn't sound that long ago, but obviously the rates of growth we've seen and the public interest now in peer-to-peer lending means that they do need to get this balance right. And the balance is between allowing market entry and innovation, as Chris said, and things like peer-to-peer lending platforms to come in and compete with some very powerful incumbent players in markets, but also to make sure that there isn't this consumer expectation gap. And that's particularly important in the UK because, of course, the models are really focused on allowing ordinary people, ordinary retail consumers, to be able to put their own money to work through peer-to-peer lending platforms and invest to get a return, as we've heard earlier today.
So does anything need to be changed, do you think? I mean, it didn't sound like Chris didn't really preempt anything coming down the track, but does anything need to be changed from where we're at today?
Well, I think the Auxera work that we heard about earlier is quite relevant here, because Auxera took this sort of independent analytical look at the market and said, well, what have we got? Where are the risks? What would a regulator need to do to make sure those risks are properly managed and ordinary little people aren't exposed to things they shouldn't be exposed to? And Auxera concluded that the FCA regime is pretty fit for purpose. However, it is thin in some areas, and it really does depend on the FCA supervising effectively. I'm thinking about things like the quality of credit risk management across all platforms in the UK. They do need to supervise that and make sure that that is robust. So that would be one. And another area, of course, is making sure that the way in which information is presented on platforms and in promotional material really does explain to ordinary investors how it works, what the risks are, and what the benefits are, so that it's clear and understandable. And I think Oxera pointed out earlier, there's an awful lot of information around on peer-to-peer lending if you really take the time and trouble to look at the platforms and read what's available. Not everyone's always going to do that. So we do need to work, I think, further on ways of really trying to get these messages through to ordinary retail investors so they do understand, because nobody wants an expectations gap in 5 years' time. You know, that's not going to help anybody.
Yep. Yep. So, and speaking of those investors, we have the Innovative Finance ISA that came into being 6 months ago, which is still seems to be languishing from my perspective. Certainly not, not where it should be. What are you hearing? Why is it taking so long?
Well, I mean, the government policy on allowing peer-to-peer lending to be included within this really very popular and well-known tax wrapper, the ISA, is very clear, and the government and Parliament have already put that legal framework in place. But what's holding things up now is the FCA authorisation process, which Chris was talking about earlier, because you can only actually offer an innovative finance ISA if you are an authorised platform, and the interim permissions that the majority of platforms have currently got aren't going to do it. You've got to be fully authorised. So we've got to get through this FCA gateway that has been going on for quite a little while now. I mean, we are very hopeful that things will move soon. I think the signs are that we're getting very close to the end of this quite laborious process, and I think, there has been some learning going on in certain quarters about how the market works and all the rest of it, but we're getting there. And so I'm very confident that we will be seeing innovative finance ISAs in the market quite soon, and
when?
They will be available. Well, I mean, most people go out and invest in their ISAs between Christmas and Easter because the shutters come down for that tax year on the 6th of April. So usually there's a great big, quite a bulge of activity around about February and March. So I'm completely confident that February and March 2017, you will be able to put some money. Well, you're not a UK taxpayer, are you? Lucky man. But lots of people in this room will be able to put some money in a peer-to-peer finance ISA, in an innovative finance ISA. Right.
Okay. So how? I know that you've worked really hard with the regulators initially. I mean, are you still in constant communication with the FCA? I mean, what the P2PFA itself, how much of your time is spent, in communication with bodies like that?
A fair bit, because if you think about the way these large regulators work, and the FCA is a very big regulator. We've got an awful lot of financial services business in the UK that they are responsible for regulating, and it's very diverse. So trying to explain and sort of get into the bloodstream of a body like that that's got its inbuilt culture and which traditionally has only really thought seriously about deposits over here and standard investment products, particularly securities over here. Peer-to-peer lending sits in the middle between those two things, and yet they're not used to thinking about something in that way. So there's been a real challenge, I think, to try and get that culture changed and explain to an established regulator that actually this is a new asset class. It is something different. It does have different risk and reward properties from these other things that you are familiar with, and you really need to think about it afresh from first principles. And that message has now got through to quite a lot of people in the FCA, but getting it really embedded and into the supervision teams and the sort of the masses is a constant job of work that we need to do.
Well, you are lucky, because in the United States, we don't just have one regulator. We have, I think it was like 15 different regulators that we have to deal with. So count yourself lucky that it's a much more efficient system, I think, in this country. So I want to switch gears a little and talk about the way the industry has changed, and back when the P2PFA was formed, this was an industry driven almost entirely by individual investors. Whereas today, that has shifted where some platforms more than others, but clearly if you look at your membership, many of the companies are very much focused on institutional investors as possibly even more than 50% of their funding. And you are the Peer-to-Peer Finance Association. So what is your official view on this change in the industry?
Well, I mean, it's part of growing up and becoming more established and mainstream. Samir, I think, explained very well in the first session this morning that having a diverse funding base is a real strength. And I think that view is shared by all our members, regardless of their business models and, the specifics of an individual platform. I think it's really a good thing about the way the UK market works, that we have this mix of ordinary retail funding, which, has lots of good things going for it. It's sticky, it's diverse. It means there's a new opportunity for retail consumers in the UK, which is really important in days of low yields and low returns elsewhere in the market. And it's a good value product. But we also have institutional money, quite a bit of it coming from public sources, as we heard, about 10% will be coming from taxpayer funds that come through in various ways, and the rest will be obviously from the wholesale market. That's a nice balance, and it's a strength for us. We think we want to keep it like that, and that's why getting the regulation right is so important.
Yeah, no, that makes sense. I feel like we've learned this year that the investor mix is very important. I think, in the United States, we have probably, in my opinion, skewed too far onto the institutional investor side. It's a function of the regulatory structure we have there, but I think it's great to have the luxury to have, I think a strong retail base is still very important, and I feel like that's something that you guys enjoy over here, and I think that's a real strength. So I want to talk about this Auxera report that you guys did. We just heard from Reinder earlier, and I read pretty much the whole report on the plane over here. It's a great thing about having a long plane, and the internet, the Wi-Fi didn't work on my plane, so I was stuck with whatever was on my laptop. But it's a really great. I mean, the thing that surprised me, I guess, was the amount of data that was shared. I mean, I guess the first point is, let's step back and say, why did you do this? Why? I mean, obviously it wasn't cheap. It's a very extensive report. I'm sure it cost a lot of money. Why did you go and commission this?
I think for a number of reasons. As we have started to grow up and we have started to really eat into some of the established markets out there and take business from incumbents, rather than just sit there and do nothing, we have noticed over the last 6 to 9 months that some established sectors of the financial services industry have started to take aim at us, and I can completely understand that. But a number of the comments that have been made, and an awful lot of this stuff is sort of under the radar and unattributable, so it's quite hard to get hold of, but we know it's been going on. But quite a lot of the sort of comments made about us to policymakers or regulators have been not founded on fact, and have been based on various assertions. For example, the assertion that we should be regulated like banks because we're doing the same sort of financial services activity that banks are. And of course, we're not. We don't create credit in the system. We don't do maturity transformation. However, there's a view out there that because we're lending, we should be regulated the same as other lenders, and most of whom are banks. So, and we should be loaded up with prudential capital. So that's just one example of some of the comments that have been made in public fora. And other things, I mean, we've heard it said that we're too risky to be there for ordinary retail consumers to lend on us. You know, we're far too risky. We're far more risky than anything else. It's all going to blow up. We've heard that. We've heard that we don't know how to manage credit risk. We don't know what we're doing. We're a bunch of amateurs. We're just lending to anyone, and we're not doing any proper assessment of who we should be lending to. So obviously it's all going to go bad in a few years. And we've heard that we can't continue to survive through a downturn. All of these points have been made. We've also heard that our incentives aren't aligned properly with the interests of investors. So the obvious thing we're going to do is stuff investors, you know, and rip them off. So all of these points have been made by various commentators, and I think we felt, well, it's really important that we actually try and get a body of evidence out there that tells it like it is, that's objective, that's independent, that looks forensically at the platforms, what they're doing, how they do it, and gives some factual evidence into this debate, because otherwise we're at risk of having a nasty backlash, which would be very, very bad for consumers, actually, and it would be very bad for both investors and borrowers.
Right. No, that's. I liked what Reinder said earlier, that there was no opinions in this report. It was all just based on actual data, and I think that's really important. So then your primary target for this, would you say, are the regulators? Obviously, you want the media to pay attention as well, so they don't misreport anything. But is that the primary target, would you say?
Yeah, I think anyone who is interested in having a retail financial services market in the UK that works in the interests of consumers. I mean, that is a regulatory objective, which Parliament has given the FCA, but it's also in the public interest. You know, in these days of very, very low interest rates and the difficult sort of macroeconomic environment which the UK is certainly going to be facing for the next period of time looking ahead, we need products and services out there that offer a reasonable deal to people who've got some money to spare that they need to put to work, but also to people who need to borrow.
Okay, so I want to switch gears a little bit before we close. I want to ask about membership in the P2PFA. I mean, you have 8 members. You haven't added a new member for quite some time, and yet the industry keeps growing and there's more entrants coming in. So I guess I'd like to know, like, who is eligible and why haven't you added new members?
Well, anyone's eligible who's been operating a peer-to-peer platform and live for at least 6 months in the UK market. And we've got the membership criteria on our website, which means that, you know, you've got to abide by our operating principles, you've got to be interested in continuing to evolve standards of good practice in the market, and you've got to treat your customers decently. That's the bones of it. And then we've got our operating principles, which require people, for example, not to discriminate in favour of institutional investors, and to publish their loan books, and to calculate their bad debt in a particular way so everyone's doing it the same way, and you can properly compare net returns and that they're honest. So those are the sorts of things that we set our stall by, and any platform out there who wants to join us, we would be absolutely delighted. And I think you should watch this space, because it is likely that there will be some additional members coming into the P2PFA pretty soon.
Okay, so you are getting a steady flow of people still wanting to come in.
Yeah. Sure, but I mean, we do set quite a high bar because we think it's really important.
So do you think that that's part of the problem is, or not problem, I guess, it's a good problem, but a challenge for the newer platforms, that the bar is, that you said, is pretty high?
Well, possibly, but I guess one of the reasons this year why we haven't been growing is that everybody's been very, very preoccupied with the FCA authorisation process, and that's probably everybody's number one priority. Right. It's far more important to get through that gateway than probably to think about joining a body like the P2PFA. Yep. So I would have thought, you know, once that's done and dusted, then we'll see how much further interest there is. But we think we have a really important contribution to make to get this market to work well and for it to be successful for everybody. So I hope we will have more interest in new members coming on stream.
All right, yeah, I hope so too. That sounds good. So then, looking forward, when you're looking at sort of your, to next year, and what are the biggest challenges that the P2PFA is wanting to take on? I mean, you've obviously done this report, which is going to help spread the word in a more what's the word I'm looking for, in a responsible way, that people understand more about the industry. But what are the big things that you're looking to take on as challenges for next year?
Well, I mean, the FCA review is going to still be in train, I suspect, until probably this time next year, when it'll finally reach its conclusions, and we could have some additional rules or some development of the existing ones. So I guess our number one priority right now in the UK is to make sure that the FCA are absolutely risk-based, evidence-based and proportionate in developing the FCA regime, which in principle we're in favour of. We think, with the sort of fast-moving market like ours, the regulator does need to keep up and stay ahead and really be on it and understand what's going on and have the right sort of regime. So we welcome that process, but getting it to land properly is our probably number one priority. But another really important priority is just to continue to try and get this message out about what peer-to-peer lending is and what it isn't. It is not banking. It is not equity crowdfunding. And the one bone I would pick with Chris Woolard is the fact that he constantly, it makes you wince. He keeps talking about crowdfunding as if the equity funding of start-up enterprises is the same sort of financial services activity as peer-to-peer lending, and it is not. And just the use of that term can add to confusion. So we really would like to be able to move away from that language.
Yes, no, I think crowdfunding. Not only is it very risky, it's also much smaller in this industry, much less significant.
And it means all these different things, so it's not very informative as a term.
Right. Yeah. Anyway, on that note, we've run out of time, but I appreciate you coming on and chatting with me today.
Thanks Peter.
Thanks, Christine.
Great to be here.